an opportunity to share my learning from the equity market, and to we collectively as a community, we always share our learnings and knowledge with everybody, so that it helps us to be a better trader and an investor in the market. Before I begin, I like to make a small disclaimer that I'm not a SEBI registered analyst and all about that. And whatever I'm sharing over here is basically for understanding and is for educational purpose only. And past performance of a stock has got no indication of future performance at all. And if at all, equity by nature itself is a very risky by nature, and one should always consult his or her financial advisor before investing in the equity market. That's it and all over there. Let's do a deep dive. This particular slide I have shown previously also in my many presentations and all over there. But I believe fundamentally is that over there, when we invest and all over there, we should understand that investment style is actually, it depends upon your own value system and the way you are basically, learning from your experiences and you're reacting to it. This is the reason why prima facie, if you really look at it, whether it's a great investor, whether it's a Warren Buffett or Rakesh Jhunjhunwala or many others of that, or even Peter Lynch. See, what happens is that over there, everybody, the market, the information in the market is available to everybody. And assuming that everybody has got the same capital, then and everybody sells at the same time, all of them should be making the same profit, correct? But it doesn't happen because of the fact that it's our human psychology which actually acts as a bar of not riding the stock when it is in the uptrend. As Peter Lynch has famously said in his book and all over there, and an investor or a trader should always pluck the weeds and water the flowers. Instead, what we do conventionally, which 98 or 99% of the market does, is that they pluck the flowers and they water the weeds. We have a very human tendency of not to cut losses. Cutting losses is something which goes against our own understanding and over there. Let us be very clear at the outside. We need not be right 100% time in the market. Even with a 20% or 30% right in our trades, we can make enough money provided we understand the fundamentals of the company, we understand the market trend, and we understand how the next 2 or 3 quarters of the company will play out. I will share with all the few examples and all over there. So it will give you a better deep insight in the process. So that said and all over there, please do not copy anybody's investment style. Always find your own way. You will make mistakes. You learn from it and all. After all of us went through 12 years of school. Did we learn everything on the first class? No. So each class was actually a support for the next class and all over there. So we learned algebra in class 6, calculus in class 9, trigonometry and all so many subjects and all. But the fact is the matter, the schooling was in such a system, our mind was very receptive to new learnings and all. And we absorbed it without even questioning why. It's only based after that post-school or college or university when we enter into a working life, our outlook towards things were shaped by our experiences. And our inherent bias, I always believe it is our inherent bias which prevents us to be successful in the stock market. See, this is the problem is that, everybody asks me in different investment seminars, webinars and all, whatever have you and all, even if I meet somebody in a party or in a conference and all, they ask me, what is the fundamental stock? How do you do technically? Nobody talks about psychology. And I remember one gentleman in this, Mr. Aishwarya, he talked, I think it was the 5th or 6th webinar when Mr. Kothari started last year. He talked about the psychology of an investor or a trader. I think that is the most important thing now. The question is how we understand what is psychology. It's very simple as that. Do we know exactly from where we are coming from and how we are going to trade and all over there? Do we always react to news or whatever it says in the TV channels or whatever it says in the newspapers? Or do we always react to what the market is saying?
What's not coming? मित्रा जी आवाज नहीं आ रहा आपका? I think he got disconnected ऐसा लग रहा है. And he will not able to join again now.
So we should also do this. So we should always do the same thing in the market and all over there. Do not think market is something which is outside your daily life where you have no control. Believe me, in the market, there's only one thing an investor or a trader can control. And what is that? It is their entry point, the buy price. After that, nothing is in their control. But the question is that one should prepare themselves to understand that in the event of any calamity or different scenarios, what will be the reaction will be. They should have a very firm mindset of how to tackle those and all over there. Say, for example, if you are going to office and you find that your car has broken down, so what do? You take a Uber, you find there's no Uber available. So then what do? You try an Ola. If it's not an Ola available, then you go to the bus stop and take a bus or a train or a taxi or over there to reach your destination. The stock market is similar to that. There's absolutely no difference. And believe me, all those people who tweets and put messages and all, I found the holy grail. There's nothing called holy grail. The holy grail is just knowing yourself. If an investor or trader understands their own psychology, his or own psychology, they are already 99% winners. It's only the 1% fundamental, technical, and risk analyst comes into the play. Okay, coming to the next slide. This is a decision problem faced by everybody. This decision problem is faced not only by ordinary retailers like us, but even by big investors like Warren Buffett also. So the question is what we should buy, when to buy, how much to buy, when to sell, how much to sell, all depends upon your psychology. Because if you find that entire market is selling and you want to join the crowd and all over there, that means ideally if I look back and all over there, one of the reasons why a good trader or an investor is very successful is prima facie they do not require that money for the next 3 or 4 or 5 years. If you are a first time investor in the market, there are three basic things which you need to fulfill before venturing into the equity market. First thing is that you should have a life insurance and preferably a term life insurance which takes care of your livelihood and all. In the event, God forbid, anything happens, your family is taken care of. The second is the health insurance. And third is that you should have at least 6 to 12 months emergency money and all. If anything happens, your family life can go smoothly. After that, whatever money is available, you should invest in the stock market. And you should never expect to withdraw that money before 5 years. Okay. Now you may say that it's a long-term strategy or short-term. I said, no, you can go to it in 90 days and all. But assuming, if you look at the history of the markets, assuming World War II was the longest period which took the market to stabilize. It was more than 100 days and all. But barring that, markets always stabilize between 30 to 60 days cycle. And if you need the money at that point of time, you should not venture into the market. The money which you will not require for the next 5 years, if you park in the equity market and have a positive mindset, you will definitely stand out to gain much more than the inflation rate and the GDP growth of the country. And there's another thing which I come across very frequently and all over here is that, this is the decision problem. We want to buy at the right time. Now, if you look at it, if it's the same stock, if you have purchased and sold many times over the last 5 years, you always, whenever you entered, you thought it was the right time. And when you sold, you always sold and you thought that was the right time. So there's nothing called a right time in the market. It all depends upon that particular day, the environment and the situation and all. And because market by themselves are very, what should I say, it's a collective of minds of so many people and all over there. One cannot predict with certainty and all over there. The question is that this is a probabilistic model, is that you should do it in such a way that the probability of winning is more in your favor rather than just venturing and buying a stock just for the sake of it's a TV stock. Buy it has fallen, let us buy, you know. And there's some investors who simply buy and they really sell. Okay, it's a good strategy. There's nothing wrong about it and all. If the investor doesn't require the money, but if you really look at the history of the Nifty 50 stocks and all over there, I will look at this way. Look at Maruti Udyog. Now, if you look at Maruti Udyog and you go to the weekly chart or the monthly chart for the last 5 or 6 years, you will realize Maruti achieved a price of rupees 10,000 or even 3 to 4 years back. Right now, it is, I think it is trading much below that 10,000. So the question is that the investor who entered at 2,000 rupees, that investor is definitely making money, assuming that Market's price is of as of today, assuming hypothetically speaking, is 6,000. So what happens is making a trades, but the question is, if the investor had understood a bit of technicals and would have got up at 10,000, not possible at the high, even at 9,500 or 8,000, he would have made 4x. Leave aside that, the opportunity cost of capital which fell from the high to the low and all over there, that investor, be it he or she, could have invested the money in a different stock to get that return. See, for us retailers and all over there, when we enter the market, is that we should not ask for fabulous returns, 40%, 60%, 100%. No, we should be very happy if our returns are the GDP growth of the country plus the inflation rate. If it is more than that, then I think we have done a wonderful job. If you really look at all the mutual funds and you look at what has happened from October, I said rather from uh, 1st of September till now, tell me one mutual fund which has beaten or outperformed us and all over there. At the same time, where investors like you or traders like you and me, we have done a much better job as compared to them. The very simple reason is that we must understand two things and all. If we are a mutual fund manager, look at from their perspective and all over there, they handle a large volume of funds. So in order to generate alpha, they have to actually put 95% of the money into the Nifty 50 stocks and all over there. 5 or 6 stocks they can play plus minus 0.5%, 1% between the Nifty and all. But for us retailers, if we have to be very consistent in between the Nifty by 10% and 15%, which is eminently possible, because last year I showed you the way I did it was around 32%, vis-a-vis the Nifty 17%. So I'm not saying every year we can beat that margin, but if we can try, it can at least try end up with 20% and all over there. The trick is that one has to do some hard work. It is nothing like this, that there's nothing called luck. If one really has to understand, be passionate about the subject, understand what is happening, assimilate the knowledge of the daily experience and respect the market, you know. I always believe that is that I never say if I make the wrong, I say wrong. I respect the learning from the market, because I cannot fight a trend which is the market is saying let's go down and want to go up. It doesn't happen that way. Okay. So, and there's another investor which I've seen is that, you know, this is good to average and all, you know, when the price falls and all over there, I bought a stock for 100 rupees, now it's available 80 rupees. So I should buy more. Okay, the question is, why you want to catch a falling knife? Is your hard-earned money, it must be worth more than that, right? Say, all look at Kingfisher Airlines and all. I remember a very eminent member, Mr. Joshi, he shared with us what happened to Kingfisher and investor when the Kingfisher started falling, they started buying more and all over there. But ultimately, the company became bankrupt. So similarly, there have been cases like this across the, if you look at the history of all the companies which are now trading in the value of less than the IPO price or it's over there, and we are buying more of the company and all over there, it doesn't work that way. On the contrary, if we know that we have a 10 stock portfolio and 3 or 4 stocks are doing good, we should ideally remove the money from the stocks which are not doing good and put the money in the stocks which are doing good. So the idea is not to have winning stocks. The question is how much money you have allocated to the winning stock, which will make a difference in your portfolio. This are the fundamental golden rules I always follow is that I I always take information from various channels, from the markets, from Bloomberg, from economists, from Wall Street Journal, from New York Times, from everywhere across the world and all over there. And I track 4 countries. I track USA, I track England, I track Japan, and I track India. So these are the 4 markets. I'm slowly developing the expertise and understanding this market dynamics and all over there. And what I have noticed is that, if you do your own fundamental research and all over there, that will help you in good state. The reason why I'm saying help you in good state is that, you have to build your inner conviction. When everybody is selling and you are not selling, because you have the inner conviction that it's a question of supply and demand imbalance. Okay, when the price of a stock goes up, when only there's demand for that underlying the products which the company produces, and the supply is not up to that mark and all, that is the way it goes up. And obviously supply demand imbalance happens in all of it. All of us have worked or working with companies which are making products for the market, and we face it in our daily life. So the question is, we should apply the same logic and understand the reason for purchase of a stock. What are the triggers which actually made us to buy the stock, and what is the parameters we're looking at before making an exit, whether in a profit or a loss. And I always, I believe in this Pareto principle. If you look at any organization, it's 20% of the people work, 80% just over there. If you look at your own portfolio, it's the same thing happens. 10 to 15% of your entire Austria stocks will give you 95% of your profit, whereas the balance is not. So the Pareto principle is everywhere. Please do not expect that you buy a stock within 5 days, the stock will start building the senses and all. It doesn't happen. This is not a Cinderella story. This is a real stock market story and all over there. And if you are an investor over there, just imagine, do you think Mr. Rakesh Junjala, he has got so many investments, right? But if you look at his portfolio, it's only 2 or 3 companies which accounts for 95% of his profit. So if a great investor makes mistakes and all, and does he at a time when the price falls, does he sell off his winning stock? No. The question is, why do we sell off a winning stock? It's just we want to protect the profit and all over that. But again, I'm nothing against it. Whether you are a short-term trader, buy today, sell tomorrow, or you want to sell it after 3 months or 6 months and all, that's a call for an individual investor to take. And they are absolutely right in their own logic. But the fact is that believe in yourself, believe in the company which you're buying, understand the data, and ignore all words. Do not get swayed by Twitter, clubhouse meetings, and all this YouTube videos and all over there. In fact, take my words with a pinch of salt. Don't even trust me and all over there. That's the way you can be absolutely a better investor. And there's another thing which I have learned over my last 3 zero challenge, which I won consecutively over the last 180 days, is that selling is more important than buying at the right price. Most of us know how to buy, but we never make a sell at the right time because we do not understand that the stock has lost its steam and all over there. As what there's some gentleman who stays over there. Any company has got if you will look at Mark Minervini's books and all over there, if any stock goes to a stage 1, it's just a small company. It goes to consolidation learns and all over there, and it enters the small cap. It slowly expands and all over there, builds up its team, beefs up its supply logistics, supply chain and all over there, explore new markets and all. And from a small cap, it goes to a mid cap and a large cap and all. So ideally, one should enter a company which is in stage 2 or making big moves and all, and exit the company when the company is in stage 3 or in the stage 4, it's a decline and all about that. Because each company, again, a company again has got a very relation. You have got a community companies and all which are very cyclical. And then you have got a 45-degree long-term compounders like Asian Paints and all, TCS and all. So you need to understand what type of company you're buying, and what are the future prospects, and whether the company will generate wealth for you in the long run. this is something I always, I never used to look at this, but over the last 180 days, I always to look, understand what has happened in all. If one wants to double their money, so there are two ways of doing it. You can do a 240% return, two stocks which gives you 40% return, you get a 96% return. Or you take four stocks which gives you a 20% return, you get a 107% return. Or you take 12 stocks which gives you only 10% return, you get a 214% return. You don't believe it? Now let's see what happens in this particular slide. Say I've just broken that into a capital of 100 rupees. If I 40% return, I get 140. I invest 140 into the second stock, again get a 40% return, I get 96 rupees. So in effect, I'm doubling my money. Same thing with 20% return. Same thing with 10% return. The only thing is the 10% return. If I do 12 times, I also invest 2x times and all over there. Now we need to understand their market goes through a different phases. If you look at 2003 to 2008, I mean, that is the closest corollary which I find based on now. I might be wrong also. But what I have noticed that we are in a structurally long-term bull market. And in 2027, if our GDP growth continues, our census should cross 1 lakh. Yes, nothing is it is nothing impossible. It is a very mathematically proven, which I think Mr. And the Motilal Oswal also has done a webinar on this and on saying that census above 1,000 is possible after 4 or 5 years. The reason behind this understanding is that a market goes to different cycles. If it is a bullish market, you can make money. Everybody makes money. You cannot afford to lose. It's only when the market is bearish and when it is sideways, we need to pick up those companies where even if we get a 5% return or a 10% return, we will still be able to double and all. In my first the challenge which I did and all over there. So I basically went through the process to understand how it operates and all. You have to be profitable, net profitable over 60 trading days. And it's not necessarily that you have to be profitable in each of the working days or you have to trade every day. You can trade and all of that. Normally, I trade 50 to 60%. That is roughly in a 60 trading day period. I trade only between 25 to 35. I don't even trade on a daily basis. I don't even look at the markets also on a daily basis. I do some fundamental research. I've automated my process on TradingView, which I've shared earlier in my earlier webinars. So what I always do is that I have ensured that the data, if there's anything requires my attention, I can play to it. So in this, when it's a bullish market, I always aim for 10%, 20%. In a bearish or sideways market, I just look at a 5% return. That's all. My risk downside risk is 2%, my upside is 5%. So the risk reward ratio is 2:1. And you really look at it, you have to be 15 times. You have to pick 15 stocks in a year, 15 stocks in a year to double your money. Is it really that impossible? So the question is that, and it's not that after 5% immediately get up. If the stock, if it is in a good uptrending trend, that 5% can be 10%, 15%, 20%, 50%, who knows? But the question is, you should exit only when the exit trigger gets over there. Do not exit based on the emotion that today the census has fallen, tomorrow it will fall further, so let me exit. Never do that. Have a very systematic process to understand, and you can evaluate yourself over time. The ideal situation is which I do, and I always shared with you earlier also, is that before entering in a trade, I make it a point to understand the company very well. I read the annual reports. I listen to their phone calls. I know who are their competitors in that particular sector. I know what is the operating profit margin. I know what is the EPS per share, whether the EPS per share is showing an incremental growth or a discretion growth compared to the previous quarter. I also try to understand what the macros of the company, also try to understand where the markets of the company, whether those markets will get impacted by the environment, macro environment. So based on all this and all, then only I choose a company and then I enter. So it's not that an entire company which is going to have, it's starting the stage 2 and going up 10%. That's very fine. It's over there. But this is the process I have built in is that I should be very clear that I'm taking a company where there is absolutely, the debt equity ratio is less. If the interest rates rising up and if a company has a large amount of debt, so then obviously the company will have to pay interest at a high, and that will reflect in their profit and loss statement and balance sheet. So my submission to all of you is that take a deep dive into the company which you're buying. So that will help you, your mindset will help you to understand whether it's the right company for me or whether I'm buying at the right time. Should I bet further? Does the company has got any future? How many
Sir,
of
can
its
you,
clients accounts for that? Okay.
sir,
So
can you inform the sources from where you are getting this information?
this source of information which I'm picking up is just an Excel sheet. I mean, you're talking about what is the backend. I will come to that, how I'm doing it from the source and all. You have, in fact, we are very lucky compared to what happened 10 years back. 10 years back, there was only money count world. Now we have got so many platforms about information and all. You have something called Stockage. You have got something called Screener. You have got something called Tijori Finance. You have got Bloomberg's. You have got, there's so many platforms available. Only one has to put some time to understand that company all over there. And you can Google, go to the company, go to the investor section, read the annual report. So what my takeaway is that and all over there, even a 5% return, if you pick up 15 stocks in a year, that is bound to give you at least double your money, provided you are invested your all your entire gains and all over there. Okay. So this is just a very hypothetical model. It's not necessarily you start immediately implementing it from tomorrow, but this is the thought process which I follow to ensure that they're constantly on the winning side of the market. So this is a process and all over there. One needs to master their emotions and all over there. No matter how much fundamentally, a strong of company or technically look like and all over there, emotion makes a breaker trader or investor. One has to be very, 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 understand the absolutely the why am I entering the company, whether I have the capability to not look into the market on a daily basis. I mean, look at after 3 years, 4 years and all. Because we do not know if a recession hits the world economy, which in all probability the signs are saying so. So do you think all the supply chains and all the macros which work well in the 20s and 21 will actually hold true? How many of us know that the Baltic freight rates went up by more than 35% in the month of May? Just imagine who will be the gainers. It's obviously the shipping companies. We are going to make money. But who will be the losers? All those companies which are importing and all, and they are paying their shipping charges based on the Baltic freight. So we have to look at the macro picture. We look at Tata Motors. How many of us know that JLR accounts for more than 80% of the revenue of Tata Motors? And JLR has not a single automobile in the Shanghai in the month of April because of COVID and all over there. So what do you think will be the impact of April to June profitability of JLR and Tata Motors? So my idea of sharing all this information is available in the news. So you have to filter out for the company which you are doing and try to understand what are the factors which will impact in the short term, what are the factors which will impact in the long term. And based on your understanding of the short term or the long term investment, you can take your position accordingly. Please do not expect the market will always oblige you with always the price which you want to sell. Markets are not conditioned in that way. Markets will surprise you, test your patience. And that is the reason why the equity market, people who actually rides the pain, enjoys the gain. It is not, we cannot sell at the top and buy at the bottom. It doesn't work there. Then that everybody should have been done that. No, we should not be having this course after all, because we all have been millionaires or billionaires on that way. The other thing is that, which I have noticed across different investors' portfolios, is that they have a very good choice of stocks. Some have got 15 stocks portfolio, some are 10 or 12. Ideally, that's the ideal size. One should not have more than 15 or 20, otherwise it becomes very difficult to manage. But having said that now, but I've noticed that stocks which have double or triple, they account only for 2% of their portfolio. So the idea is that if a stock is doing well, allocate more money to the stock till the exit is triggered. I shared the example with all of you of a company called NIIT. Okay. So if you look at fundamentally understand what is happening, the change is happening in the company, you will understand how the bigger play is happening. So in the world, if you look at it, the developed world where most of our IT companies are there in the Europe and in North America and all over there, the cost of labor is going up. So all these Fortune 500 companies, they if they have, they are answerable to their stakeholders, to shareholders. So if they have to make a profit, they have to get a handle on their cost. To get a handle on their cost, they have to go for automation or to get rid of businesses which are not in their core competence. See, learning, training, and development is it's a very essential for a company, a Fortune 500 company to train its staff across the world, or any multinational for that matter, so that everybody works at the same pace, have the same focus, at least achieve the corporate mission. But the fact of the matter is that now all this training is getting outsourced and all over there. The COVID period actually accelerated the change and all. If you look at NIT and all, they have started every quarter, they're getting companies which, and whenever they are taking the company, they're having a 3-year contract. So for 3 years, the revenue visibility is there. So my idea is that if this company, assuming 4 years down the line, takes care of 150 Fortune 500 company with a 3-year horizontal period, and normally if you have noticed, if you take a training partner, you normally don't change until and things go bad, they are not delivering as per your own goal metrics. So the question is that the revenue is assured and all about that. So what I'm trying to say, if you understand how the company makes money, it becomes easier for us to have the conviction to buy a stock at a certain price and understand how the market will shape up. Look at BDL, Bharat Dynamics Limited. How many of us actually heard of the name just before this they started this missile Russia Ukraine war and all over that? So BDL manufactures missiles and all over there, surface to air, air to air, water to surface, and all over there. And we are getting orders from countries like Philippines. They're getting even, I think they're in talk with the Middle East to supply their missile. So if you look at it, one should understand how the macros are playing out and which are the companies which are in a position to take benefit of the macros and all over there. We are very, very much short-sighted of knowing whether the senses will go up and down, whether it's trend up and down. So those things are not in our control. What is in our control is to understand how a company operates and ensure that the company is walking the talk, and listen to their phone calls, visit their annual reports, and make it whether the company's EPS will go and now money will go automatically. And the other thing which I have done is that thanks to Mr. Kothari for sharing the Haikinashi the video, I found that the Haikinashi the candles and all actually helped me to become a better trader and all over there, because it cut out all the price noises and all over there. So I actually look at the stock if there is in a trend, and whether it's a daily or weekly, both are in the positive, or the weekly or the monthly are in positive, and then I enter at the stock and I exit again based on the RSI, whether it cuts the moving average, 14-day moving average from above. I will share with you. So my idea is that, and whenever one enters a trade, one must document like at what point they have to exit. That exit, if you documented it, it enters our subconscious mind and all over that. And we should not be very greedy. Okay, the stock might go up another 10-15% more. Leave something on the table for the other investor also. One cannot squeeze all the profit just for himself or herself. I mean, that is the way I've seen stocks which have got up too early. That's a mistake I made. Stock has gone up 35%, 40%, but my target was only 5% or 10%. I'm happy with that. So learn to have an exit strategy before you enter a stock. Have a trading journal, maintain it very religiously, and learn from your mistakes, because when I go back and look at 2021, I understood what mistakes I did. I will take the learnings from that and do not do that again. That is my request to all of you. Okay. These are a few qualities of a successful trader. I'll just have two more slides, then I will go to the screener and the trading view to share with you some live examples. See, one needs not be trade every day, because these are all self-explanatory. Martin Ping is one gentleman which I really respect a lot, because he actually thinks, and he has crystallized in a book the 18 rules which makes a very good trader on an investor. I mean, these are all his words and all about that. He says, if you feel, if you're something in the back of your mind, your sixth sense is saying you, please do not invest on that stock. Stay out. It is better. Even if the stock goes up, doesn't mind. There are other stocks which will help you to make that profit and all over that. It's not like, fear of missing out should be absolutely zero for our professional traders and investors. There's nothing called fear of missing out and all over that. What is fear of missing out? I cannot chase 100 stocks. 100 stock company will do well. The NSE 500 consists of 500 companies. 500 companies can do well. Can I allocate money to 500 stocks which will make a difference to my portfolio? Obviously not. So the question is that always before you enter the trade, understand the reason. But if you have a slightest doubt, stay out from that market. Stay out from that particular trade. And the other thing is that, never believe in luck. Never. You make your own luck. You do your own due diligence. You understand the company's business fundamentals, and then only you enter the company amount. That will actually help you from not only building up conviction, but also help you to understand and exit the market before the company goes down under. Because you are in tune what is happening with the company. And always act on your own judgment. Do not rely what a TV channel says or this channel says or your group, some expert says and all over that. Nobody is an expert. The only expert is the market. We are all students over here. I'm learning every day, 24 hours a day and all. I don't consider myself an expert at all. I'm a very humble student of the market. So always act on your own judgment. And, if we are going to do what 99% of the people does in the market, how will we make money? If everybody is selling and we are also selling, everybody is buying, we are buying, then how will we make money? And how do you think the other investors, the big investors, they make the money? So think about that. Think what is their condition, how they have got that money. So we also need to adapt ourselves. I always believe in the confident view. Walk independently in the market and have your own belief, stick to it, and you will definitely come out successful. And the other is don't overtrade, because each trade has got an impact cost. How many of us knows the brokerage service charges? There's nothing for free in life. We have to pay transaction charges to the NSE, the BAC, and also to the broker and all over there, and add GST to do that. So the question is that if we trade too many times and all over there, that it impact cost eats into our overall profit. And always, after a successful trading cycle, take a break. Take a break away from the market, recharge your batteries, make something worthwhile, read a book, go out for a walk, enjoy a vacation, come back and start again. Because each day is a new day. Then always take a period mental inventory, is that always I check what are my biases and all, inherent biases, like which prevents me from investing into the company. Each one of us has got inherent bias, whether we like it or not, perhaps we are not aware of it at all. It is there in a subconscious. It's only if we take our time out, close our laptop screen, keep away the mobile, and listen to ourselves, like why I picked up the stock, why I'm not picking up that stock, what is the inherent bias, or why I'm not selling the stock when I see there's no company, the future is not there, why I'm keeping a loss in my portfolio, why I'm allowing the loss to go. So these are all the biases which in our psychological makeup, which actually acts as a hindrance to being profitable in the market. And always constantly analyze your mistakes. Just go back to your school days when we made a mistake. We used to go to the teacher or we asked our friends who got the problem right and say, show us the steps how to do it. So the question is that if you make a mistake, understand the reason behind making the mistake and ensure that there's some learning from the mistake which you did. Because I believe a mistake teaches us much more than any guru in the market will actually teach us. Because the mistake helps us to reveal ourselves our mindset as an investor, whether you are high risk investor, whether we are moderate investor, whether we are a conservative investor. And it's always that don't jump the gun. Okay, everybody's fine. The stock has gone up by 10%. This is the right time because tomorrow will go up by another 10%. No, it doesn't work out that way. You understand, take your time and all. The market gives you ample opportunities to enter. Market gave an excellent opportunity to enter in March 20. In November, when I said it will fall to 15,500, because I could see what was going to happen and all. You can't have excess liquidity which is coming into the stock market and resist the price of commodities go away unchecked. Look at what happened in Venezuela. Look at what happened in Argentina. Look at what's happened in Turkey for that matter, the leader for that matter. And look at the Indian companies which are based in Turkey and look at their balance sheets and the profit and loss statement, then only you'll understand what I'm talking about. So my submission to all of you is that take your time. There's nothing hurry. Markets are not going anywhere. Markets will be here and will be there so long as human civilization is there. Only thing is that you should take your time to understand when you're going to enter the market, and you should enter the market based on that, whether you have the capital set aside for investing in the equity market. Don't invest or borrow money from somebody else to invest in the market, which is a very cardinal sin. And the other thing I have noticed is that, it's not over there. It's generally as that, everybody says the market will turn around, this will turn around. Those are absolutely meaningless. Is the question is, do you think the company's working of the company, the fundamentals of the company changes by what is happening in the market? The company is doing their work. They are selling it to their customers. They are making the margin. So if the price drops by 10%, does it imply that the company's future is doomed? The answer is obviously no. So have a reason. If you are entering a market just because only on price, only on technicals, then your exit should be based on technicals. If you are entering on fundamentals, then your exit should be based on fundamentals. Don't mix up these two. These are very two different types of traders and they are very two different types of investors. One is very fundamental driven, the other one is very price driven. But stick to one, whichever is convenient for you. You can merge both. You can have the techno funda approach. But the fact of the matter is that define a process which is comfortable for you, which helps you to understand based on your understanding what is your limited experience and all. All of us have got limited experience. We don't have an experience which takes into the entire knowledge of the market in our braces. So we should always allow ourselves the time to take a trade, and we should take it as per our convenience. And one should never enter a position with the first extraction risk reward. There was one gentleman in a book who given an Excel sheet. I found it very useful. He said this is the risk percentage, this is the trade and all. If you want a 2% reach, how much, this is your capital, how much stocks you should buy, how much, what will be a stop loss, everything and all. Make a simple Excel sheet and all and follow that. Cut losses. As I will say, cut the weeds, do not cut the flowers. Because if you get a habit of cutting your losses, we are very comfortable. 10% loss, we don't do anything. It goes to 20% loss, we don't do anything. If it goes to 40% loss, we still don't do anything because I'm already stuck. You have to wait for the market to go up and all, then only I will recover my basic thing. The question is be very ruthless and cutting losses and all. Any stock which goes below 8%, I follow the 8% rule. I simply cut it. If I make a loss, I simply absorb that loss. But the idea is that you should enter the market or time it in such a way or enter based on over there where the risk reward ratio is more in your favor than against. And it is always, instead of putting all your money in one stock or two stocks, put it on low risk ideas. At least this will give me a 5% gain, 10% gain. Allocate your money across, ideally if you have a 10 stock or a 15 stock portfolio, you should have a 10 or 12 sectors. So 10, 12 sectors again helps you to, access the hedge against the macros and all, because some sectors will do well, some sectors will not pay. Allocate equal proportion of money, see how the market operates and all. And if there's a winning stock, after 90 days and all, add more money, remove the stocks. If you find that the stock's future is not good, remove it. You should exit if the trigger, if your stop loss trigger hits and all before that. And I always advise everybody and all, whoever asks me for advice and all, always look down, don't look up, because we cannot determine at what price we will sell. We can only determine what is our own losses. We can determine our buying point, and we can define how much loss we can take. So if this two is only we can control, others is absolutely we have got no control. And one should never trade beyond what you can reasonably afford to lose. Because if you want to lose 10,000 rupees, ensure that you lose 10,000. Do not take a bet of 1 lakh where you're going to lose. No, be very conservative in this, because the markets are not given any direction or indicator where we will go. So one needs to conserve their hard-earned money and capital, and ensure that is prudently invested in the stocks which actually has got the potential. And don't fight the trend. If the market is downside and all, don't say for that. Wait for the market to correct and go up and all. Out of 240 trading days, if we do not do trading for 100 days, that markets will not fall or our portfolio will not fall. So we always have to have the right time and the right mindset to invest and make money. And wherever possible, please trade liquid markets. I have seen, penny stocks, those stocks which doesn't have any liquidity, somebody buying a huge thing and all of that, very difficult to sell. It always hits the upper circuit, and when it goes down, it always hits the lower circuit and all. So in the morning at 9 o'clock, one has to give a GTD for the lower price and all, lower circuit price to exit and all. So let us try not to do it and all. So ultimately, if you look at this, we can proven strategy. You have a strategy, if you understand how to handle it, you have the risk management in place, and you have the mindset. The intersection of these three particular circles, it gives you only the profit. And the idea is to stay in that particular zone only. Okay. This is another famous thing which needs no introduction and all over there. This is by Marx Minervini and all over there. He also shared this more or less the same thing. Most of you have seen it and all over that. He says have a very conservative portfolio, and time your trades, manage. This is the same, essentially the same thing and all, which is over there. So let me take a break here, and then I will come back again. Okay. Just okay. Yeah. Screen. Yeah. So this screener is actually a very good place and all over there. So one can, analyze the company and all. It gives a very useful information. And you can develop and customize your screens, which I've shown in my previous webinars. They are different and all. Now, what I've actually added a few more things and all over there is that I have added Warren Buffett value stocks and all over there. So these are the stocks which actually it shows up as got a value and all. And I have customized it based on these parameters. The price to earning is less than 20, price to book value is less than 2, price to free cash flow is less than 20, the PEG, price equity growth ratio, is less than 2, return on invested capital is greater than 10%, gross profit margin latest quarter is greater than 50%, pledge percentage of the promoter is less than 20%. I always deal with companies where the market capitalization is greater than 100 crores, debt to equity is less than 1, and the change in FI holding is greater than 0.5. So this helps to pick the company. And it's not on that, there are different screens available, which I use over there. This is a Ben Graham formula and all for undervalued companies and all. It's not that all these companies will be very good fit. I put them in a technical chart, do a deep dive, try to understand whether these companies will actually make money, what are their competitors and all over there. So the idea is that use screener, it gives very good. It also gives the annual report of a company and all over there. It also shows you what you call the con calls and all. One can use it to understand more information of the company. Okay. Say, for example, if you look at BBL, Bharat Dynamics, they're sharing a lot. So we can see Bharat Dynamics and all over there. What is the market cap, current price, high, low, stock P, what is the return on capital employed, the EPS quarterly growth is how much percentage, exponential it's how much and all over there, promoter holding, and everything we can see over here at a glance. We can also see what is this margin, whether it's 50-day, DMA, 2-day DMA volumes and all over there, see how much volumes has come. We can also look what are the pros, what are the cons, what is the peer comparison, HAL and all over there. You know, you can see so much things about the company. You'll be in a better position to understand whether the company will make money for you or not and all over there. So, and you can always have the, who are the promoters, who are the APIs, so the APIs are buying. Okay, they're increasing. So, but the public can also slowly increasing and all over that. It is the March 22 and all over that. So my idea is that screener actually helps you to pick up very good fundamental companies, explore it as much as possible and all. Next comes the trading view. Okay. So normally the process which I follow, I'm just sharing and all. So every day, before I begin and all, I always look at the Nifty 50 index for the last 5 days. And I actually look into that. I basically check 5 parameters: the Nifty small cap 50, Bank Nifty, BSE 500, Nifty mid cap 50. So it gives you a fair idea where the market is heading and what duration. Now I take 5 days. Sometimes I go to 1 month to see how it is fair. And sometimes I go at 3 months and see whether which particular sector has taken the maximum beating and all over there. So the reason why I do it and all, let's try to understand how the market capitalization of the Indian stock companies are. Historically, it has been saying that the mid cap and the small cap market capitalization averages, I'm saying averages, between 14 to 15% of the total market cap. Large caps being the more and all. But in this recent downfall, the mid cap and small cap has come down to roughly around 7 to 8% instead of the statistical average of 15%. Second thing is that look at from the other perspective, the economy is going to grow, as all of you are aware, even the World Bank or even the economists have said 2022, the Indian GDP growth will be the highest in the world. I'm not going into the exact number, whether it's a 7% or 8% or any other factor and all. The fact is all other institutions are aware that the Indian GDP growth will be there. So if that happens and also the market capitalization, the size of the pie will also increase over the years. So what is happening is that the pie is increasing, while the mid cap and small cap pays and all over there, their share is shrinking. So statistically speaking, sooner or later, say in the next 5 years, they are going to catch up and reach 15%. So most of the mid cap and small cap company, the small cap will go to the mid cap, or mid cap will go to the large cap. So we have to keep an eye open in the market to pick up those companies and all, to whether they have a long runway to go, whether they have a good distribution channel, whether they have their own moat, economic moat, which prevents others to come in and all. And they have a position to dictate price to the customer. If they're rising the input cost, they can increase the price and all and ensure that the operating profit margin is protected. So if we have an open idea of what is happening in the market, then only we can pick those companies which can actually double in the next 5 years period and all over that. So this is the essence of understanding, is that, have a 5-day or a 1 month over there. Instead of on a day-to-day basis, one understands exactly which of the segments in the market, how they operate it. The next thing which I always do is that I look at the sector which are playing out. And similarly, I look at the 5 days again, which are the sectors like CNX metal has gone up 5.85%, whereas IT has gone down by -2.13. If I look at the 1 month period, you find the Nifty has gone down by how much? -4.8%, whereas media and metal has gone up by 13.7. So all sectors, the money keeps flowing across different sectors at different times. So one should pick up a time span and all about that based on their understanding of the market and all, and position themselves into the leading companies to get a return of a short term of 5% to 10%. The other thing which I do is that I look at the dollar index and all over there. See, so whenever the Nifty is about the US dollar index and all, it keeps on rising. The moment it falls below and the dollar index goes up, Nifty falls below. See, all this Nifty is trying to get back and all to its model, and also the US again, the dollar again has softened this is the rest of the currencies and all. I'm talking on the last 48 hours and all over there. So we have to wait and watch how the Fed go, whether it goes for 50 basis point or a 75 basis point and all, because there's so much liquidity. The Fed has got no option but to tackle the liquidity. The other thing is that why I personally believe and all over there, it's only the next 2 quarters, the April to June quarter and July to September quarter, will not be very good for the Indian companies, because they have to get a handle on their inputs, the raw material cost and all over there. And also the IT companies and all the attritions, which were very high in the 2021-22 period, they will take at least 2 quarters to stabilize and all before they have a firm idea of how much it will go. And I always believe this 2 quarters, that's April to June, July to September, will be a good time for all those investors which are want to pick up very fundamental sound companies. Based on that investors' understanding and research, then only they can hope to make money and all over there. And I always request is that if you don't need the money, please do not sell the company. If you have now sitting with a 30% loss and all, please try to understand the company. If it is going to go well, you can hold because of that. If it doesn't go well, even after 2-3 quarters and all, you need to come out of the company. That's what I'm saying. Then the next, which one I will share is, just a second. Yeah. Just a second. Just excuse me just for 5 minutes, please. Just excuse me.
का प्रेजेंटेशन जबरदस्त होता है. I've unmuted everybody, so if anybody want to say anything till he comes back.
सर ये भी स्क्रीनर में दिख रहा है क्या, ये सब जो चार्ट सब है?
नहीं, ये तो ट्रेडिंग व्यू में दिखा रहा है.
अच्छा,
ये ट्रेडिंग व्यू में दिखा रहा है. पहले जो दिखा था वो स्क्रीनर दिखा था. अच्छा, स्क्रीनर डॉटेड एंड दिस इज अ ट्रेडिंग व्यू. क्या मतलब?
I'm sorry for the interruption and all over that. Thank you, sir, and all over that. So this is one stock. This chart I follow very religiously and all over there. This, the entire commodity, I map it against Nasdaq and all. And if I look at a 1 month period, Nasdaq has fallen by 16%. Nifty has fallen by only 5%. Gold has taken a beating, copper has taken a beating, coffee has taken a beating. Only the US oil, cotton prices has gone up, but I expect the cotton harvesting will start from September onwards, and the cotton prices will soften therefore. So because textiles is one of the leading exports of India and all over there, and it's going to gain more traction because as per the government's PLI policy and all of that, textiles is one sector where they expect there will be a lot of exports going forward and all over there. So I expect it to soften. The reason behind is that why I monitor this and all, I also take a 3-month view, I take a 6-month view and all, to understand exactly how it is playing out. If you look at year to date, very interesting, that is from the beginning of this 2022. Look at the Baltic freight from the month of May. It has gone up by 142.7%. Just imagine those companies which are actually having Baltic freight as one of their input costs in terms of logistics, how much will their margins get hit if they are unable to pass on the increase in the cost to the end customers. US 10-year yield has gone up by 70.75%. I'm talking about from year to date. US oil has gone up by 45.47. Cotton has gone up by 25.65%. That is one of the reasons why a few cotton companies has got a bit in and out. Okay, so aluminum has gone up by 6.35. So what I'm trying to say is that this numbers keep changing and all. And if you are an investor or a trader, one should have an idea of how the commodities are playing out in the market and what are the factors likely to affect and which are the companies which will get impacted and all. If the food prices rise, obviously all this company which depends upon food, the paint industry, they will be forced to hike their rates. Look at what Asian Paints did not hike the rates when it was required and on the third quarter of 21, if I'm not mistaken. Their margins and took the hit and all over there, the EPS growth and the market punished them. Then after that, they were forced to increase the price in the month of January and all over there. They increased, I think, 2 or 3 times. I'm not sure. But the fact is that commodities plays a very big role in that, and we have to know how much is the commodity cost of the company which we are investing. I have got different models, but I've kept to the very simple ones. Yeah. Okay. This is, I mean, for the last 3 months, I'm only following this. And I will share with you what exactly I look at and all over there. So this is the performance matrix. Okay. So if you're in TradingView, you can look at over there. I've just given you the names. One is performance, one is volume, one is EMA 9, EMA 18, EMA 50, EMA 100, EMA 200, and there's something called tabular price time frame continuity. And I always have the RSI and the EMA moving average 14-day period. So now what I do is that I also follow that Donchian channel and averaging up and all, which I explained to you in my previous webinars 9 months back. I also follow that. But if I'm going to I follow that also. It's not, there's nothing wrong in that process and all over there. But I found this is very easy to guide. So over here, what I have noticed is that I always take a position, and these are all Heiken-Ashi candles. I always take a position when the RSI cuts the moving average from below. Okay. I always take a position. And I always exit a position when the RSI cuts the moving average from above. So all those who are in algo trading, as Mr. Sudhir, I think he is in this forum, he has requested me. This is the only algo I follow. There's nothing else. I enter only when the RSI is going above the moving average of 14. I exit at this point. Now you will say, why are you not following the free stop or parabolic SAR, which you have mentioned in the previous webinar? The reason is that that was in bullish time. So it took time for the company to fall. Right now we are in a bearish market and there's sideways movement. It's falling very drastically and I want to protect my profits very fast. And look at this, when this doji forms and all over there, I know that the length of the candle is coming down and all over there. It is going bound to fall and all over there. And most of the time, I'm not saying 100% of the time. So out of 10 times, if I take this on this logic, I'm correct 7 times. 3 times I fail. But 70% is my absolutely win success ratio in that, because I know that it will go down and all. There's a long wick is forming, which means neither the buyer nor the seller is getting control and all. So the idea, if I exit at this point, I protect my downside by this much. Again, I enter at this point when this RSI is again cutting the moving average from above, and I again exit when the trend starts going down. I exit and all of that. It's very simple. I mean, the only thing is that one has to have the patience and not jump in every trade and all over there. Look into this, understand this, and then enter. And obviously, the company has got a bright future. Like Blue Dot Express, do you think the company will go out of circulation in the next 2 years or 3 years? And if India GDP is going to grow, the logistics and all is going to increase and all over that. So my idea of sharing is that there are some people who always buy on the high. I also used to do, and used to go higher. Nothing wrong in that. But in a sideways market, bear market and all, if we know how to protect our downside and enter only when the signals, the technicals give us the signal to enter. Look at this particular thing, very interesting. This is 9 March. And this is 25th May. The company has already gone, right? The company has moved from this point 5626 and has gone to 7216 in this bearish market. So the idea is that one has to keep an eye on which of the companies are still holding strong in a bearish market. What is the reason? What are their earnings? How much they have done? Because if you look at the earnings of the last quarter, which was declared on 5th May, they had a 37.87% increase compared to what it was projected, the EPS surprise. So don't you think the market will reward these companies which are able to generate more money for their stakeholders? So it's very simple logic and all over there. It's nothing which is beyond anybody's comprehension and all over there. And obviously in the hiking Ashi and all over there, we should look at least the 2 of the trends should be green. Here in this particular case, in fact, all very good companies, all the trends are green. And if the signal is there, one can enter. Okay. I mean, that's all I have done. There's another thing which I always do is that, let me share one more thing. I have a multi time frame to understand if institutions are buying and all over there. It's basically 1 minute, 5 minutes, 1 hour, 4 hour method. 4 hours is that 4 hours makes 1 day. So I know half a day trading, what was the outcome, half a day trading, what was the outcome next. Then the other thing which I always do is that, I always do a volume session analysis and all to understand and all about that. So if, for example, in Apple, on this particular date, somebody must have bought a very huge volume and all, but the selling has been very meager. So selling is getting absorbed, the supply is getting absorbed. So like this, I go through various charts and all over there, and I go through charts many times and all to understand how the market will actually handle this sort of companies which have got a long runway, has got a good profitability growth, and how the company market is fitting this company. And last, which I do, and I check it as and when the company results are out, I always check the fundamentals are all over there. Again, in trading, you can create, basically look at the basic EPS earning per share and whether the incremental growth is on the higher side or not. If the incremental growth starts going down, okay, a company might have a bad quarter because of things beyond one's control. But if it goes down for 2 quarters and all, and it comes close to my exit criteria, then I will obviously exit from the company. I will not wait for it to give a call further and all over there. So this is the way I do my trades and all over there. Just to give you a perusal. Each one has got their own way of model and all, and every one person is correct in their approach. Now I'm sharing something very interesting over here. Somebody did a study from 1995 to 2018 or 2019, and they found very simple as that they will only buy, then the time frame is on a weekly basis. They will only buy when the stock is actually the 10-day EMA is greater than the 50 EMA, and they will exit when the 10 EMA is lower than the 50 EMA on a weekly basis. If they had followed the process, just imagine on the right hand side how much profit they would have made based on the initial investment. Sri Cement 25,408%. I'm talking about a 15-year period. Motor 10,000, Jindal Steel 10,000, Wipro 6,000, Page Industry 4,000. So just imagine this person only follows such simple strategy, weekly basis, 10 EMA and 50 EMA. He goes long when 10 EMA is above. He exits when 10 EMA is low. And the same set of companies, this is the profit he makes over the years. Interesting. No? I also never believed it when I saw this particular model. I thought I would share with all of you and see how they operate. And that comes to my end of my presentation. Only thing this last is over there. My request to all the members present in this forum and in YouTube is that, always bet on sound fundamental companies having quality management and positive financial headwinds. Initiate always a small position and average up based on rising trend. Okay. Suppose you want to allocate 1 lakh rupees to a particular stock, start with 10,000 rupees. So even if the stock goes down and all, your loss is protected to the extent where you have put your stop loss over there, 2% or whatever it is, or 8%. Whereas don't invest all at one go. See how the stock is reacting to the market. And then only if you find there's a firm upswing and the RSI is above the MA and it is going up, start adding more money. Suppose you have got 100 shares, it goes up by another 50. It goes up by another 25. So slowly what is happening, your average first price is always less than the current market price of the particular stock. So with the market turns out, if there's some bad news of the company, you get an ample, cushion to exit for the company and protect your profit. And always remove your losers periodically. This is something which I always advocate. If a company is not performing, it's better to bite the bullet and take the loss. Because there's no point in keeping in loss and over there. Would you like to keep money in a bank fixed deposit which gives you negative 6% in a year? The answer is obviously no. Then why are you doing the same in your portfolio and you are not allowing your portfolio to shine and all over there? And in this choppy market, it actually gives you a good opportunity to understand, weed out all your mistakes and buy into those which are going to be fundamentally strong in the next 4 or 6 quarters. And increase allocation of the winners and let it run. And this is the normal chart and all. If you have a loss of 10%, the stock will have to go up by 11% to gain. You have a 20% loss, you have a 25% gain. You have a 33% loss, the stock has to go up by 50%. So let's be very realistic and all over there, how the market behaves and how we take our position of entry. And these are the books I did. I kept reading a lot of books and all. Normally I read 1 book per week and all over there. And it helps me to understand different people, the way of handling market and all over there. And this is all. The psychology of money is something I recommend to everybody, every investor or a trader to read this book. Not only once, read it 10 times, 15 times, 20 times. You will understand what are one's inherent bias and how to remove it. And as I said earlier, markets are very easy. It's only your mind which makes it very complicated. Understand your psychology and how to filter out noise. And thank you all for your kind attention and patience. Thank you.
Now I have unmuted everybody, and you can ask your doubts, questions, anything for the Mitra ji. And thanks a lot for a wonderful presentation, Mitra ji. Yeah.
Thank you, sir. Thank you.
Yeah, forum is open. Any question you can ask. Thank you.
Yes, sir. Good morning.
Good morning.
Sir, for daily day trading, how to select your stocks?
I don't do trade. Okay, let me put it this. I don't do day trading. Okay. I don't do day trading and I don't do future options. I don't do currency and all. I don't do BTST. I only, most of the time I wait for the stock to come to my portfolio and then only this one. Then I invest. I don't do any intraday trades. I don't do future option, no currencies, nothing. Absolutely.
Okay. Okay, sir. Thank you.
It's entirely different mindset. What Mitraji is following is entirely different. It's a great skill. That is what I'll say. To have the conviction about your own trades and then trade. Great, sir. Yeah. Ram, any question?
Yeah. So Mitraji, that the three pillars to stock market success, the risk management, discipline, and knowledge. So you have highlighted, so nicely, and I'm very sure that would have gone into everybody's minds. And you had given so much of importance to those three pillars. And I must thank you for that. And the simple indicators, you have given, that high can achieve with EMA. I think that will definitely help everyone, even for doing positional trade also. And I remember PKG carried out, one interesting exercise, to identify top 10 for future investment, that is, I remember sometime back 2-3 months back. And then I still remember that you had mentioned about Jamnato and Titagarh Began and Mirza. All that, I was watching. I used to watch those scripts closely. And despite, this kind of bear market, they have, hardly fallen maybe some 6-7% from the all-time high. So that is the, I would only request that, this top 10 list be, updated also once in a while based on your R&D and then the R&D of other members. Thank you once again for a great presentation.
Thank you. You've been very kind enough.
मित्राजी एक मेरा सजेशन और था कि आज आपने जो ट्रेडिंग व्यू में यू हैव शोन वेरियस चार्ट ना, if you can include in your presentation one slide how to make that setting. If you are willing to share those settings, you can have one page on each chart. How you made that settings, what indicator we have to take, and then what settings we have to take. Then it will be very easy for all the members.
Understood. But if you want to, I can show you again and all. Say it is only one has to have a trading view, and one has to enter those indicators and all over there. And those indicators by itself they fall into place. EMA 9, EMA 18, and EMA 50, EMA 100, and EMA 200. That's one.
My suggestion is that you add one slide, add 1 or 2 slides in your presentation, and then make those settings. So so that you can do it.
I'll keep that in mind. I will definitely do that.
So when I'm sharing this presentation with everybody, they can copy those settings and then they can do it. That will be great.
Okay.
That will be great.
I will do that. Thank you, sir, for pointing out.
Yeah.
Abhijit ji, thanks for a wonderful presentation. I've got 2 questions. One is that you are saying that the GDP growth in India will be maximum. Can you just brief on that one?
No. Sorry, sir, I couldn't get you for first question. What is the first question?
You said India's GDP growth will be maximum this year.
Okay.
So you can give a little more details about that. And second thing, you said 10 EMA, 50 EMA, you have selected so many EMAs. And when you said the RSI crosses the EMA, what is that EMA? Is it the 14 days average EMA? Or
14 days. It's 14 days, sir. It's 14 days.
14
It's
days.
RSI is 14 days.
Okay.
So the India's GDP growth is something, say, let's look at it in a different context. If you, I always believe an economy can go if we have a 140 crore population and all over there. Okay, and we have actually created a large, the labor, the demographic dividend now is going to play out and all over there. Yes, the COVID has been a lesson for all of us and all, but if you really look at it and all, and the very facts, if you look at it from a different perspective, where a Nasdaq falls by 15% and our Nifty falls by 5%, in spite of so much selling by the FIIs and all over there must be some inherent strength in our economy, which I believe that is taking all the right boxes to do it. Let's try to understand how the bottom has shifted across from there. We always do have around 3% rate of growth and all. If you look at Professor Mahalanobis, when he did the first 5-year plan and all, they laid all the basic the infrastructure, steel plants, dams, and all what have you, and all over that. That's the foundation. Then we had the green revolution. Okay, earlier prior to that, we used to import wheat from abroad. Now, if we stop export of wheat, the world reacts. Can you imagine what is happening? So a person who has seen the 4th decade of the Indian economy understands the shift which has taken place and all over there. India is in the top 10. If you look from the manufacturing, the commodities, everything and all, we are now, taken over companies and all over there. The other day, Mr. Aditya Birla, who had taken over Novelis when nobody told him not to buy Novelis, and he says, I'm going to invest $1 billion Novelis in America to expand the aluminum sector. So that shows the resilience of our Indian economy. It shows the Indian industrialist and all about that. That is the way I look at it. There's a lot of shit that's happened. It will take another 2 or 3 sessions to cover all that.
Mitra ji, I'm Anil Gupta. Sir, say I have Steel Authority of India. I consider it as fundamentally strong company, but its average share price is falling. So as you mentioned, one should not average down. So by averaging down, when the price goes up to say 100, I can exit. So what should be done in case of a company like Steel Authority of India?
Sir, it's like this. And my request to all the persons who are asking questions to at least put your video, so at least I can recognize by face and all over that. And otherwise, it's okay. Let me take your question. It's like this. If you have fundamental stocks and it goes down, before entering a fundamental stock, please do a simple technical study in the sense, look at the monthly chart, look at the weekly chart, monthly and weekly. It will give you a fair idea to understand whether it is a cyclical play or not. Okay, that is number one. Number two, market actually discounts much earlier. See, it's not that if the company's profit has done well, the stock should move up day after tomorrow. It doesn't happen that way. But the market always discounts. It looks what is going to happen. Excel is definitely a good company. It has got its own captive, iron ore mines, own captive coal blocks and all over there. And they have reduced their debt to a considerable extent. The debt in their books has come down because of the massive profit margin which the commodity cycle paid out in the entire calendar year 21-22. But I believe the market is actually looking at all the metal companies for only a short-term factor. The reason if recession happens, okay, abroad, there are two aspects and all. If the market is within India, then obviously if there's more investments on infrastructure and all over there, steel is bound to do well. And obviously the steel consumption per Indian is very low if you compare to other developed countries. So it's a long cycle. Yeah. Why I'm saying is that not to average down, sir, is basically because of only two reasons. how do you know that this is the lowest it will get? On the contrary, sir, what I would suggest is that you wait for it to reach a bottom, let it consolidate, and the moment it goes up, and you can see only in 2 week time frame, it has shown 2 green candles, then only you start buying. The question is, do not catch a falling knife. A stock can fall 50%, 60%, we never know, and we put more of our money and all over that. Instead, the money which you're going to put in averaging down, if you put that money into another stock, which you like, and you feel it fulfills both your fundamental and your technical parameters, you can make money out that stock instead of allowing it to, wait for it to turn up. Because please do not make any investment on the basis of hope. I agree. We have to be very optimistic. It's nothing that. But averaging down, if you can come out of that, if your psychological mindset comes out of it, I will never average down, come what may. If only if the stock price goes up above my buy price, then only will add. You will see a fundamental shift in your portfolio wealth creation strategy.
So I have a
Yeah.
question. I mean, it has happened a couple of times with me. For example, I have a list of stocks which I want to buy when the price comes to, hits my buy price, which I want to buy it. I bought that stock at that price, and that price is such that that very next day the stock is 20% up. Like for example, Apple 2 days back, I bought it, and next day it was 20% up. And it has happened couple of times. But what happens that I do not sell it at that point in time. Very next day I'm getting 20%. I do not sell it because I have bought it with the vision that I'll keep it in my portfolio for long term and whatnot. Now, the advice I am looking at is that should there be a parameter in investing where if you get enormous return in very less time, should we book it or should we add more, or what do I do? It has happened with Dixon, with Deepak Nitrite, many stocks with me that I buy and very next day or day after they goes up and then they again comes down. So how do we handle that, or how do you do it?
Fair answer. So my submission will be, before entering a stock, please have a trade journal where you write down your profit expectation and the time frame. Because most often we always look back, but at the time of entry, when you are entering, you have done your own groundwork, you have chosen a very good company, you have entered at the right frame, but only add 2 more things. Till what time you're going to hold the company, or what is your profit expectation from that? If you can write it down, it gets embedded in your subconscious mind, or in your technical chart, you can draw a horizontal line at the price you're going to exit. So that is the way to play out. See, this happens to everybody, sir. It not only happens with you, it happens with everybody, as every trader or investor. The question is that you have to understand is that what is my reason? That's what I'm saying. In a sideways market, if I get any stock which gives me a GDP growth, assuming it is 7% this year and inflation is another 7%, it gives me 15% growth, I'll be more than happy and book profit. Provided I will book profit, provided the stock is not given any exit triggers. If the stock gives exit trigger, I will come out. But if the stock is going up and there's no exit triggers in place, I will average up. That's what is my submission.
Thanks, sir. Thanks. Understood.
लेकिन राकेश जी, मेरा एक सबमिशन है कि जब भी आप ऐसा स्टॉक खरीदो, बाकी लोगों को भी बता दो भाई 20% बढ़ने वाला है दूसरे दिन। तो हम लोग भी खरीद लेंगे और उसको एल्गो में लगा देंगे फिर।
No sir, I just been fortunate couple of times, that's it.
No,
Yeah, sure.
Rakesh, you must take one more leaf, out of Mitraji's presentation today, since you are already working on some indicator-based algo. So many indicators we discussed today, particularly Heiken-Ashi, EMA. and things. So you may take note of it. Thank you.
Sure, sure, sure.
Yeah. Any other doubt, question?
I think,
Hey,
sir,
we have-
everybody.
Hello, sir. I
We
have
have
one.
an expert available today, yeah. You ask as many questions.
Yes, sir. I had a doubt.
Yeah.
Sir, about
No,
two
yeah.
Uh,
Carry
one
on,
was
carry on.
that EMA crossover, how to plot it on the chart, and also you are using sir daily time frame or sir weekly, sir. That was one
No,
of the doubts.
yes. See, I'm following a daily time frame because I'm looking at only 90 day, that is a 3-month period or roughly 60 trading cycles. Okay. So I look at the daily. I occasionally look at weekly to see the inherent strength of the stock, but whether it is always above the blue line, that is the 9 EMA line. Otherwise, I'll always look at it on daily basis. Okay. But what I always do is that in that particular chart, if you have this indicator called tabular price time frame continuity, it helps me to understand it whether the chart is always, I can actually the video which Kotaraji has kindly shared with all of us and all. It clears very straightly that read the trend across 2 time frames. If the 2 time frames it is green, then it is absolutely the stock will run for some time and all about that. So that is the basic premise, and I have qualified it with the bottom RSI again on a 14-day period and all about that. Is that it should cut the moving average EMA 14 from below. That's all. These are the 2 handles because otherwise it's very difficult and all. If you have a cluster of indicators, it gets confused and all over there. In fact, I'm now working more. In fact, perhaps again after 6 months or 9 months, if Mr. Kudaraji permits, I will come. Perhaps I have a more simpler version of how to trade in the market, because I'm now trying to move away as much as possible from too many indicators, too many clues, and all, trying to keep things simple so one can operate it with these. Thank you.
Good, very good. Really
Sir,
wait
one
for
question.
your-
Sir, we see, sir, one question regarding BPCL. We have taken play for it, this investment play, but this is not going to be happen. So what we have to do? We have to just from the stock, or we have to
See, as I directly said, we should never take a trade on a stock based on news. Okay, we should trade a stock based on the fundamentals. Okay, and the definition of fundamentals varies from company to company. See, let's understand, across centuries, when James Watt invented the steam engine, okay, coal was the fuel of the 19th century, correct? Similarly, if you look at World War II, the diesel, petroleum products was the fuel for the 20th century. In the 21st century, when you find that all the oil industries, all the oil companies across the spectrum, be it British Petroleum, be it Shell, be it Exxon, Caltex, or whatever, Phillips, see, everybody is not putting in money in upstream investing. If they are not putting money in upstream investing, instead they are moving into green hydrogen, they're moving into EVs, they're moving into tidal, they're moving into solar energy. So the future is shared something which we like and all of that. Now look at, I'm not saying it will happen overnight, it will take a shift. But then when Henry T. Ford bought out his first vehicle in 19th century, 1910th, 20th century, they were horse-driven carriages. There were only 1 or 2 cars. Within 18 months, there was only cars. There was no horse-driven carriages. So you can draw your conclusion from there. Whether you want to invest in a sunset industry or you want to invest in a sunrise industry. That is the only, my learnings will always say that. I will never trade on a stock based on news, disinvestment and all, because those are factors beyond my control. I never know how it will pan out. I hope I'm able to answer your query.
yes, sir. Thank you, sir.
Good
Actually, Mitra ji,
His question is
earlier,
now what is the BPCL position? You are ex-BPCL, you know very well about a BPCL is a diamond. So how do you rate right now BPCL at that 330?
Because at this
340?
price also it is not in a premium valuation. What valuation it is getting earlier as compared to HPC and IOC, same valuation it is getting now. So there is no disinvestment premium is given by the market.
So what is your view, Mitra ji, on this BPCL now?
Sir, it's like, gazing into the crystal ball. But the fact of the matter is that if I'm not a astrologer or a soothsayer or not, but if I read the writing on the wall, it is going to be privatized either tomorrow or the day after, or perhaps like in the case of Air India, it happened a few years down the line. I think that's what the general indication is and all. And it's too early to say, because if I have understood correctly, the Department Secretary, he said that they will look into it, the disinvestment in a different light and all, whether it's splitting the company or something around, which I have no clue. I'm actually clueless, like all of you in this particular forum or watching on YouTube and all. So it will not be possible for me in this position and all to comment any further. Thank you.
Abhijit Mitra ji, good afternoon.
Mitra ji, earlier,
see, I want to ask a question whether these all indicators are lagging indicators. What do you suggest on open interest, which may be a leading indicator to some extent?
Okay, sir, it's a very good question. The question is, these are all lagging indicators, but for us retail people and all over there, because I actually do not take care of the open interest with the options, futures and all. That is my drawback, I admit. But the fact of the matter is that what I have noticed is that even among the lagging indicators and all over there, AMA and all, the Heiken Ashi and all over there, so within 24 hours or within 2 trading days, you are able to make a trade and you can exit or with a profit or loss and all, you protect your capital. You do not allow it to get wasted away. That's one. Second thing, if you look from the indicator perspective, sir, my submission will be, to track, there's an indicator called DTR versus ATR. It's a daily true range versus the average true range. And that is actually, sir, is a very, it is not a lagging indicator. It is very good. So the average true range, sir, is actually tells the difference between the high and low of a particular day, or the difference between the low and the low of the previous day, or there's something that takes the average of it. It moves out all the biases and all about that. So if you find the average true range and the daily true range, it is less than, daily true range is less than the average true range by 70%, and your relative volume of that particular trading, again looking back 14 days period, is that relative volume is again less than 100%, and everything is going good, one should enter the stock, because I believe at that particular point, the market has not yet discovered that, and the professional traders and investors have started nibbling on the stock. And those are the clues I look. So the reason why I focused on VDL or Apple for that matter is that I noticed very large institutional buying, sir, between 3 o'clock to 3:30. In 1 minute, the price shot up by like 80 rupees. I still remember I shared it in one of my posted in this financial freedom group and all. So if institutional investors, when they start buying and all over there, and this actually gives you a fair idea of how to go. Yes, there's limitations, sir. I fully agree, but we have to work within the limitations to the best of our capability.
Yeah, one more thing, Mitra ji. Suppose the time frame wise, see the trend forms in the first smaller time frame, then it extends to the higher time frames.
Right.
So,
absolutely, sir.
So, but how to finalize? Suppose sometime it reverses also. It's difficult to predict the trend, how it goes from smaller to higher. See, 1 second, 1 minute, 1 week, 1 day, like this.
Oh, okay.
So already 5, suppose weekly
Okay.
and monthly is established a upward trend, but 1 minute and daily trend is coming up with the downward trend. So how to judge between the two?
So very good question, sir. So the way I handle it, and I might be wrong also, is that I actually look at the day, week, month, because that's the tablet time frame continuity. So when I look at it, if I look at the day and the week, I don't look at the month very much because I'm a short term 90 days, 60 days trading and all. I look at the day and the month and all over there. So what I do is that I say both are green and the RSI is about to cut the moving EMF from below. I initiate a small tranche. Say, for example, if I got to 1 lakh to invest, so I invest 10,000 rupees. And I wait to see how it reacts and on how the general market or a particular sector reacts. Then I put another 10,000 rupees. Okay, slowly I start building over the position. The moment I look at it over there, the trend turns negative, but I don't look at the trend, and I look at the RSI. I mean, okay, it's a trend. I look at the RSI. If it is cutting down, it's going to move down. The EMA 14 from below, from above, I exit at that point. Okay, so you get a handle, you get the right time to enter, and then it might go sideways or whatever there, but you don't allocate your full money. You allocate in piecemeal basis. So even if the market assuming then bad news hits the market, like for example, all of us didn't expect the RBI governor to come and say during the market hours that I'm going to increase the rate and all over there. So the market reacted very well. So those are things it's not in control for any of us and all. What we can do is to protect our downside and ensure the capital which we have put in is at least start with a 0.5% allocation and all. After that, if it takes up, it goes. And normally, sir, if you look at the fundamental company, of course, different time frames, you will notice there are certain stocks which comes down, but again goes back and all. So that helps you also to understand the particular stock behavior. Mostly, I've noticed that the whoever the players in the market, they do not allow a stock to fall beyond a certain level. They will allow it, and again, when the excess supply comes over, then it's taken away. Then there's no supply coming, the price shoots up. So our idea is to ensure that when we are buying at that point, there's no excess supply. Even if the excess supply comes, people who have bought at high prices will sell. But the company's fundamental is so strong that the institution will not sell that company, will keep on adding. They can ride the trend. And it's very easy to say, very difficult to practice. I fully agree with you. But the more we handle charts, if you handle 50 charts on a day, I mean, after 3 months, when you look at any chart, you can say what will happen the next day. I mean, it's the way you can infer on it. I hope I'm able to answer your point.
Yeah, thank you. The last question, the stop loss, if you put for 8% or 5% or 10%, what are the stop loss? Because nowadays algos are so much that, operators are trying to get the stop losses and make the market down to hit the stop loss, and they will make the profit.
So my idea, a very good trader is one who doesn't need a stop loss. Okay, let me answer it this way, sir. Is that we put a stop loss because our brain is inherently said, let's put it our backside. Okay. Ideally is that it's very natural and normal thing to do. There's nothing wrong with that thinking analogy. But if you are a good trader and you enter at the point when all the technicals are lined up in your favor and you enter with a 0.5% tranche, so you are actually eliminating the possibility of a stop loss. It's just like, sir, you're driving a car with a seatbelt on. You have the insurance, but driving a car without a seatbelt and driving a car with a seatbelt, that makes the difference. That's that.
Okay.
Thank you.
Okay. Thank you. Thank you very much, Mitra. So
Thank
nice.
you,
Sir, what kind of trading you believe in? You are not doing future and options.
No, I don't do.
You do any kind of trading?
No,
Not at all.
I only deal with equity in the cash component. I don't do any other thing.
Sir, I have actually, I think I've not got it right. You say your holding period is 90 days. So do you expect a result in 90 days, and if there's no result, you exit in 90 days?
No. I don't have any holding period, please. I have a holding period till the time my stock reaches my expectations of profit and the time frame. It can happen in 1 day or 2 days. If the stock goes and hits my loss risk reward ratio, I exit. My holding period mean to say after 90 days and the stock is still going strong, I will not sell. I will keep on adding, like which I have done for NIIT. The question is that I still have a position in NIIT and all over that, but I have trimmed the profit. If we sell, we don't sell everything. Selling is also an art and all over there. You can, if it reaches the 9 EMA, you sell 50%. If it reach, or you can sell 25%. Let it reach 18-day EMA, you sell another 25%. But the idea is that you have bought a stock and you have invested your time, energy, and your hard-earned money on it, and you have averaged up. And anyway, your price is always lower than the current market price, right? And if you want to protect your profit and you say, no, the stock will have no future and all over there. And in fact, if you listen to the con call or if you look at the annual report and say no, then obviously we'll exit. It doesn't mean if I have a 10 or 15 stocks, I will all enter and exit at the 90 days. No, I might even exit within 48 hours after it reaches delivery. I hope I am able to answer.
Got it. Yes, sir. Thank you. Sir.
Thank you.
Hello, sir. My name is Anil.
Yeah.
Hey, I had a question. I'm saying, I can ask in Hindi or English is fine.
You can, but my Hindi is very limited.
Oh, okay, okay,
That's
that's
okay. Please,
got it.
please
No,
share.
no.
Please share.
Okay. So the thing is, you told about that you select 15 stocks, right? For a year, you select 15 stocks. How do you fundamentally select those stocks? I mean, what are the rules or what are the parameters based on which you select the 15 fundamentally strong stocks?
Okay, fair enough. See, this I have explained. If you, I will explain again for your benefit. But for those, I request. I have Mr. Kotari. I've got 3 more videos where I have explained very much in detail. I think my first video, fundamental and technical analysis, where the parameters on which I select the stock. But to recapitulate it and all, I always look at the stock. I look at it in 3 time frames. That is a 10-year horizon, and a 5-year horizon, and a 3-year horizon, and the current. The idea is that the 10-year, 5-year, 3-year, the profit growth and the sales growth should keep on increasing. Okay. And the operating profit margin should be increasing. The debt to equity ratio should be less than 1. Promoters pledging should be as low as possible over there. And institutions have increased their stake. They have not reduced their stake. They have increased their stake. I mean, this is the few and all. You can add more based on your risk reward or your appetite and all. Some play with market cap of 5 crores. Because those are very small companies and their financial records are not available very easily and all. I have to go to the BSA site, read about the company, read about its promoters, find out whether they have any sister concerns or not, and whether they have any, what should I say, intra-linkages with other players and all. So that's a very cumbersome exercise. So I've taken the lower side market cap 100 crores and all and above. So these are the basic parameters and all about that. And this is the way. And if you go to screeners, you will find there's a lot of screeners available and all based on the type of investor you are. And there's another very good forum called Value Picker. And if you are not there, suggest please Google and join the Value Picker forum, because there are a lot of investing enthusiasts and all. They pool their knowledge and share the knowledge about different companies, different sectors across different time frames. So one has it adds to your knowledge before you enter the stock. Thank you.
Yeah. So you just mention one stock, new stock which you have entered, new stock which you might have entered recently, and the basis thereof.
I don't do that. So. No, I never do that and all of that. I have
value group कौन सा है sir? ये value group कहाँ पर है? Where is the value group? Is it a WhatsApp group or what?
Value Picker.
No, this is WhatsApp or Telegram?
it's,
No,
it's
it is. I'll spell it out. It is VALUEPICKR.com.
yes, absolutely right. Absolutely right.
Can you put in the chat? And
Sure.
And is it a Telegram group or what?
No, it's a forum. It's a website basically. I'm putting it right now in the chat.
PICKR, I think.
Yeah,
PICKR.
I have put the link here.
Okay. Yeah, value picker
All
is
right.
there. Right.
Abhijit ji, Chandra here. While you said your exit criteria is based on you reaching your profit target or even selling if there is a downtrend downfall you see, again you're based on charts you exit. But from your past 1 year, what has been your average time holding period, average holding period for your stock? If you have that data, or if you remember that data.
Okay. So my average holding of a stock, I think Lotus Lab was one which I hold around 130 days. And the average, if I look at a very interesting question, I have to look at put all my trades and take the weighted average and all. But if you really look at it, it must be somewhere between 70 to 95 days. I'm making a hazardous guess. But I have to do that. Thanks for pointing it out. I will have to do a deep research on that.
Yeah, no, because from the figure that you're mentioning, Vijay ji, you're looking at, so you're a positional trader, no doubt, but you're not a long term, you're not holding any portfolio for the longer term. Is that
Yes,
correct?
Sir.
Okay.
Yes, sir. The reason, because I always believe, sir, I believe in the dictum called opportunity cost of money. I know this is something very ingrained in me right from a very early age and all, right from my school days. So the opportunity cost of money is that if I invest in a stock and I see the stock has gone up by 18%, and I see the technicals and the macros suggest the stock might have gone up to weak quarters and again pull up, why I should allow my capital to be blocked for just 120 days or 90 days for that matter, because I'm not going to earn any return from that, correct? So on that contrary, sir, if I use that capital in some other stock, where at least if I make a 3% gain or even a 4% gain, and that too within a matter of 90 days, I think that is a better alternative. So in economics, we always we have a concept called indifference curve. Okay, so if you have a basket of your stocks and you have your budget, and it all depends upon where you want to play yourself. I'm a very, very conservative, risk averse, one of the very risk averse person and all of that. Because fundamentally it's written to me and all over there. I'm not here for adventure. I'm looking for a very decent return. That's all. I'm happy with 10%, 15% return. I mean, I leave 100% to other people.
Yeah. So yeah, but again, but you can be classified as a trader perhaps than an investor, because like Mr. Joshi always talks about investing, staying in the market for 5 years, staying in the market for 10 years, so that you get so even some of your large cap companies also can become a multi-bagger. No doubt, of course, mid cap and small cap good ones will become multi-bagger even in a shorter time frame. I just trying to understand, that perspective where how you look at it.
I know, sir. So what Mr. Joshi, which he has explained in his webinar and also what that, it is something very positive. And obviously, sir, because we are in the market because of our passion for the market. Otherwise, if we have been, working 24/7, we don't have time or the energy to devote to the market as we could have post our retirement. But having said that, and also my fundamental thing, I only add one qualifying fact to that and all. Assuming you have a 10 stock portfolio, sir, if you look at every 6 months and all are doing fine and all. But you must also have your inherent expectation of if a stock is actually having a loss for over, say, 3 quarters, 4 quarters, why you should keep your money in that stock? Ideally, you should get rid of the stock and you buy the stock in your portfolio, which are doing well, which you might be holding over 2 years, and you add some portion of the money and over there. So you are averaging up, correct? So my idea is that whatever in the long run or the midterm or the short term and all about that, always focus on the stocks which are showing strength and has got the inherent ability to create wealth for your portfolio. And never exit those stocks too early. Okay. Because, okay, in fact, that is also one of my dilemma. I've exited a stock saying that again goes up 40. But I'm very, because when my expectation level is only 15%, 20%. And because if I look at only pick 15 stocks in a year and take only 5%, I can do I can double my capital in 1 year. Correct? I mean, that's all of us are looking for. So logically speaking, I mean, that's a mathematical, it's not actually will pay out. It might say one stock might give me 10%, another stock might give me 3%, another stock might give me 20%, another will be minus 2%. But that's the way it plays out.
But the difference is doing it successfully, sir. That's the problem. Okay, thank you.
Thank you, sir.
Sir, I have a question. So, as I understood that you pick a stock, you decide a price according to you based on whatever parameters you have, and you wait for it to come to your price, and then you buy, and then with certain profit or your 8% stop loss logic, you exit the position. Now, my question is that in this year, it looks like that will work, but in 2020 and early part of 2021, when we were in absolute bull phase, right? No stock was coming down at all. So at that time, I mean, do you recalibrate your or change your base price or the price you want to buy stock at, because it might be possible, or that is also the part of the question, that had you faced that difficulty that you have a list of stocks and the buying price which you want to buy at, and the stocks never touch that price? If that is the case, then how do you handle that, if at all that was the case?
Yes, very good question, sir. And that's a very good question. Let me answer you in 3 parts. The first part and all, the market has got different cycles. As you rightly said, 8% loss was when we were in the bull run. The moment post November or December onwards, I have kept my loss at 5%. After March, I have put my loss at 2%. And obviously, it's not that every day I put my what do you call, the net, and no fish comes and come and all. It happens many times and all. But I'm very happy with that. The reason is that because I've learned to, this actually, it is very easy to say, but it is only for an investor to understand and all over there. What makes him drive to the market every day, open his screen and buy? Is it for the sheer, that adrenaline which runs through your body and all, if I see the spike of that? Or is it that something, okay, I can live without it because I have put my automations and all in fact that something comes, it will come to my time. Because what I have noticed is that, persons who are always glued to their screens and all over there, their mind actually gets, the subconscious mind, it always plays back and all over there. And it is very essential that at least with the 5 trading days a week, you should at least take 1 or 2 days off and just watch from the sideline how is it playing and all over there. Then you will get a better handle and all over there. I have seen the stocks which I have decided to buy, the price got triggered, but the volume quantity was not that which I wanted to buy. Suppose I wanted to buy, say, for example, I'm given a hypothetical example. I want to buy 10,000 shares of one particular company at that particular price. I'm getting only 500 shares. Will I buy? I will not buy. Because my entire proposition was to buy the 10,000 share at that price, and I was looking at the return which I will get and all. Then I have to rework this. So the idea is that, yes, many of the times the stock will simply go by and all. In fact, the stocks which I have entered, they have found it so difficult to handle, they will throw me out at every opportunity. They will go into gyrations and all over there. But then I realized it's not the stock's fault, it's my preparation. It's that if my preparation is right, I should enter and all. That actually, but the last 9 months, I've been filtering my technicals only to understand exactly how can I have a model which will be true in a bear market, it will be true in a sideways market, and it will be equally good in a bull market. I hope that answers your question. If you have any more doubt, please free to call me on WhatsApp or Telegram. I'll definitely try to resolve it for you.
No, sir. Thank you. Thank you, sir. The last question from my side, that since you are trading only in cash, so what about money management in the sense that do you keep all the cash with, suppose you're trading with Zerodha account, so do you keep all the cash in Zerodha account as is, or you put it into some liquid fund or like something like that, or just keep the cash as is, so that because opportunity can come anytime? Yeah.
I think I asked this question to Mr. Kotarji 1 year back. And he simply calculated and said it doesn't make sense to pull the money from Zerodha and then put it in liquid fund and all. I always keep, I always endeavor, and let me be honest up front, I always fail. I always try to endeavor a 30% liquid cash position, always. Okay. The reason is that sometimes market goes down in such a way where you can pick it up like anything. Okay. So those over there, always try to keep a 30% liquid cash and all. And ideally, I keep the cash in whatever the Zerodha account is that, which I will not require for the next 5 years.
Thank you, sir. Thank you. Thank you very much.
That's a good thing. I'm also following the same thing. I don't do all these things, moving the money to liquid fund or bond fund or all those things. So by the time you get back your money, your opportunity is gone. So I also believe strictly what you are telling. Let the money be there, and then you take the.
Mitra ji, in the current scenario, which sector do you suggest to concentrate?
So
these are all dynamic.
Sir, if you really ask me, again, I'm hesitant to guess. I think IT sector is something which I will focus very, and I'll be very choosy. It's not the sector per se. I have to look at the company, and I have to look at the attrition rate, and I have to look at its future revenue, across which verticals the revenue is going to come, whether it's going to come from logistics, whether it's going to come from telecommunication, whether it's going to come from auto, or whether it's going to come through other verticals. And I have to take a call. But right now, I always look at sectors where the entire market is neglected. Because I believe, let's look at this way, sir. Name one sector in the country, like in India, which gives you the highest foreign exchange. Name one sector which gives the maximum amount of profit. IT only. So the answer, sir, you know the answer, sir.
Yes, sir.
I mean, that's the way it is.
And sir, in the IT, if you compare Infosys versus TCS, both have fallen drastically during the last 10 days. Which one you will prefer, Infosys or TCS or SCL Tech, something like that? Which you will prefer?
I will prefer none.
You will prefer none?
Just the same logic which I never look at large mutual fund managers. The same logic, I don't invest in large caps. And here the qualification is that I always invest in small cap and mid caps based on my risk appetite. I do invest in large cap, 1 or 2, but I don't put too much.
I remember KPIT, your favorite in. I hope you are still holding on to that.
Sir, I do not have a. This is not a question for Abhijit sir, but it is just an observation that I see a lot of people talking about the attrition rate in IT. So I do not understand that. How does that qualifies to be a parameter to deciding a company? Because if in, say, employees from TCS, there is a high attrition rate, that means these guys are not going to go and sit at home and start trading in stock market. They will definitely either going to Infosys, Wipro, Accenture, or any other company. So overall, these people keep moving in the IT industry only. So, I mean, just an observation that why we should, keep attrition as a, not for the sector as a whole, we cannot take it as a parameter. For an individual organization, yes, we can, yeah.
Okay, Rakesh also is from IT sector, I think. He's working for IT sector.
Let me address the observation. Very valid point. Say, if I understand correctly, TCS has got a rule that if any employee leaves, is not rehired again. I understand. I might be wrong. Okay. It is like this, sir. Assuming you are in TCS and you are in charge of the cost. Okay. If people start poaching on your employees, so what you do to prevent your talent from going outside? You obviously you have to increase your price hikes, right? So that means you're increasing the salary, which is eaten into a margin. And please remember, sir, it's all your existing contracts, they have written based on certain parameters and all about that. You can't increase the margin. Second thing, sir, if you look at Infosys, look at their training center in Mysore and all over there. They have to induct so many college students. They have to put them in the grind and all over there. And all of us have worked in different Fortune 500 companies. We know how much the training cost and all over that. So this cost actually impacts the organization bottom line, whether we like it or not. So until and unless the talent and all over the war for talent, it's going to be even fiercer in the next 10 years. The reason being is that talent is something which everybody loves for. You find there's so much talent in every sector. You look at it and the price. I've seen, I know, because I know a few of my close relatives, they've got offer for 7 companies and they turned down and they went to the 8th company, right? So the fact is the matter is that, and second thing, sir, look at this, how you build client confidence. It depends upon your onshore and offshore mode, okay? And now with the COVID going on, obviously your onshore cost will be much more. Your ATF rates have gone up. You put any rate on a Skyscanner and look from Bangalore to say New York, and you just monitor it for 15 days, you will understand how much a return ticket, the price has gone up. So who bears this cost, sir? The cost is borne by the organization. So that's what I'm saying. The IT company will require at least 2 more sectors or 2 more quarters to get a handle on the acquisition cost and all. Yes, the TCS acquisition rate has been around 18%, Infosys 23%, other companies are around 28%, 30%, 35%. From where will they get the talent to handle their clients and their forward contracts? I hope I'm able to help you understand.
Yes, sir. You have given a different perspective to me to look at it. I mean, obviously, I was blindfolded with one view only. Thank you very much, sir.
Thank you. Welcome.
Sir, regarding the gold, I just want to ask you one question. Generally, when the equity is down, gold goes up, but now it is not. So what is the reason, sir? And should we invest in gold?
Sir, I look at it, I mean, this is my personal observation. I've got no bias and all. I consider it's a dead bet investment. Yes, it's true. The price, it always catches up with inflation. Gold has been there, right, sir, from Mohenjo-daro or from the Egyptian civilization or from the Inca civilization. So gold has been actually an exchange of currency and all over there across the years. It's only in the mid 70s when the USA ditched the Bretton Woods system and moved the crude price and everything moved to the dollar. But that said, yes, gold has something of value and all. Even if you look at the previous generation and all over there, I mean, gold was the only thing they used to coordinate at the jewelry shop, take some loan to build the house or educate their kids and all. Gold has got some value. I have no doubt about it. You can have 5%, 10%. Again, it's based upon the comfort which you are in. But if you ask me and all over there, if you look at gold, statistically speaking, has never been return more than 8% or 9%, just about inflation, sir. It has never gone about inflation. But if you look at equity across a 100-year time frame and you frame gold on that, yes, there are certain periods where gold has outperformed equity. I fully concur with your view. But there are some periods where gold has underperformed. And now if you are an efficient capital manager, how much portion will you allocate to gold and all? Obviously, but gold, you will definitely have a portfolio, you have your jewelry and all over there. But the question is, are you generating any return? See, always the fundamental question which all of us should have, how much is the return I'm getting in? If it is a zero return, then obviously my money is blocked into the asset until unless I sell it. Correct?
Correct.
I hope I will.
Sir, I'll add to this. I mean, that is my view. As Mitraji said, that gold is a dead asset. I totally agree, because it has got no industrial use. Instead of gold, if gold has only got the value because of the sentiment and from like history we have been accumulating it. If you really want something like that to be in your portfolio, then you should look at silver, because silver has got industrial value. It is used in making a lot of medicine or blah 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 industrial things. So technically silver can never go to zero. Tomorrow gold can go to zero. Tomorrow the whole world will say, okay, we'll use Bitcoin or something else comes up like that, because gold has got no, technically it has got no value.
I will add one more product, that is cryptocurrency. Mitra ji, what are your views on the cryptocurrency?
No, cryptocurrency. Sir, I was very much against crypto, and I shared with you earlier also. I'm absolutely and all about that. Because something, sir, if I don't understand something, I never go into it and all. The reason behind is that it has to have some value for me. Okay. I mean, I'd rather, with that cryptocurrency, I'd rather buy a book and read a book which will add more value than the cryptocurrency. That's all I have to say.
That is right.
I think that'll be all, sir. It's 1 o'clock, nearly 1 o'clock.
I just want to make one announcement. Mitra ji just said that we should take the vacation from your trading occasionally. Correct? So I am taking a 3-month vacation now. I will not be available for next 3 months for any webinar. However, my Zoom is available to anybody. If anybody want to give the webinar or anybody want to take any session, he can take my login ID and password and he can conduct the webinar. I will not be able to do it till I come back from my vacation. So there is just a small announcement. Huh? Yeah.
Sir, Kothari, one request. You can ask the experts in the group to make some presentation sharing their experience.
Yeah, you can use it. Absolutely no problem. And then you can coordinate with Rakesh ji or with our Lalit. He will do all the setup and everything. And then you can have your webinar every Sunday or whatever thing. But I will not be able to do it because the time zone difference will be there. So I will not able to do it. But anybody can use my Zoom is available to everybody. Anybody can do it. There is absolute no issue.
Hey, Kothari, what I'm requesting is you can put this thing in the group for the experts to share their experience.
Rajan, the issue is that you have to have a host, right? Then only you can have the Zoom meeting, na? So somebody want to do a Zoom meeting, then he has to start, and then only he will be able to share the screen, and he will be able to give the right to anybody. So unless you have that right, then you cannot do it. You can start the meeting anytime, but then you will not be able to share anything. So somebody has to take the responsibility of hosting the webinar, which I am taking for last 2 years. Correct. So if you want to take, then you can take. I have absolute no issue. Because this account will be lying idle now. The Zoom Pro will be lying idle. So anybody can use it. What I'm saying, I will not able to participate, or maybe if I get a good time or if I'm able to adjust the timings, then I may do it. But I will not be able to really focus on the Zoom meetings now for next 3 months. From the first week of September, I will start again. Okay. Ram, can you take over? Ram, can you take? Then
एक रिक्वेस्ट है जो अभी इन्होंने जो बताया ना, when to enter into the stock, that is EMA वाला और when to exit it plus RSI, थोड़ा सा ग्रुप में डाल देंगे तो बहुत अच्छा हो जाएगा।
नहीं, वो तो मैंने बताया।
10 days नहीं, अभी अपना इसी ग्रुप में हमारे एल्बो ग्रुप में 10 days EMA और 20 days EMA का जो क्रॉसओवर वो सब बताया ना सर साहब ने।
भाटिया जी सुनिए, वही बता रहा हूँ कि मित्रा जी has agreed कि he will share his presentation and he will add 2 or 3 slides where he will give all these details on the indicators. ठीक है ना? तो वो आप 2-3 स्लाइड आप देख लोगे तो आपको आइडिया लग जाएगा कि अपने को क्या सेटिंग करना है। ठीक है ना? Because when we are listening ना, we are not actually implementing it.
हाँ, करेक्ट।
तो अपने को थोड़ा वो देख के फिर अपन वो सेटिंग कर लेंगे। तो मित्रा जी एग्रीड हो गए कि वो 2-3 स्लाइड उसमें ऐड करके and then he will share the presentation.
ठीक
है। Thanks a lot for that, Mitra ji.
Yeah.
And Kothari ji.
Yeah.
Okay. Thank you, Kotharaji, and all. Thanks everybody for bearing with me for more than 2 hours. Thank you so much.
Thank you very much, sir. Thank you. It was really great presentation. Thanks a lot.
It was our pleasure, sir. It was our pleasure.
Pleasure to have
Thank you very much.
Thank
you,
Thanks, Abhijit ji. Thank you.
Thanks a lot.
Thank you, everyone.
And I'm looking forward to volunteer to take the Zoom meeting, sir, so that anybody can do it. Yeah. Thank you.